Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tigre. Our victim of the day is Mike Jones. He's the CEO of West Fault Mining. Used to be a company by another name working on the Hasbrook slash Three Hills project out in Nevada. I've been there. I'm pretty sure I was there with Mike a good 10 years ago, and a lot has changed since then. Mike, why don't you go ahead and give us an update on what you're doing and why investors should be interested now?
Well, this is a really solid reserve of gold sitting in Nevada that's fully permitted to be built. So that says a lot. There are not many of those, and it's great value. So the net present value discounted after tax of this gold stock is $5 US a share, and it's trading at $1 Canadian. So you're able to acquire a reserve of gold, proven and probable reserves at a very low price, which should appreciate to be more valuable with it in line with its peers. So the project is extremely attractive. It's $700 an ounce to produce gold here. The net present value is $295 million, and the project has a 92% internal rate of return. So it's very good value of high margin gold sitting safely in Nevada, and that's why you should own it.
Okay. Well, I got to say, I remember those numbers from the top of your presentation, but those are at $1,800 gold. And as we speak, it's not 1,600 and change anymore, but this morning it's over 1,700. But those numbers aren't quite up to date. Um, but I know that I remember from the feasibility study or pre-feasibility study back in 2016 that it had been calculated like 1,200 or something, or
Yeah, we used 1200 as the base assumption, and we acquired this property on a pretty simple set of metrics that we were looking for something with a 20% internal rate of return at $1,200 gold. And you're right. Listen, the gold's been between 2,000 and down to $1,600, so you can take your pick. I mean, at $1,600 gold, the net present value is 232 million US and a 74% internal rate of return. So it's still
it
extremely
still
attractive.
works. Yeah, I
Yeah,
remember, and even back at the 1,200 number or something, you still have like a 40% IRR or something. So it was
35 IRR, very good memory. Exactly,
so
$92 million NPV 5 after tax and a 35%
very
IRR. Exactly.
robust. Okay, so why hasn't this been built yet? I mean, this is what really got me hooked on this project in the beginning. As you say, here you are, you're in Nevada, it's not Botswana or Timbuk 5 or something. It's Nevada, it's high margin, it's right on the side of the highway. It's outside of
Exactly.
Tonopah. You've got all these things going for you. Why is it still in development? What's taking so long?
So listen, the permitting process has been arduous here. I mean, anywhere in the U.S. now is quite a long process, and of course, we went through the Trump expedited process, which the Bureau of Land Management just put a new process, which was short form at the beginning of the old process. So we went through all of that twice. So we fully permitted the first pit at Three Hills under an EA, a short form, and then we went and started Hasbrook, and we completed all of that. So we've been permitting this for 5 years, and that's a
Sorry,
warning
let me
to
jump in, Mike.
anybody out there that it can take that long.
Yeah, okay, but I remember that was one of the selling points. The EA was supposed to be the faster, the short form. Why did it take so long?
There's nothing unusual about this project. Show me a project these days that gets through an EA in 2 years. There's not many, and it takes a long time. All the specialist studies, the work you have to do. We've filed tens of thousands of pages of documents under an EA. So, that gives value to the project. Of course, the fact that this is fully permitted is a very valuable attribute. And, as to why the shareholders are not pulling the trigger now, I mean, we could actually build this project tomorrow morning if we wanted to. We could start with trucks and go.
That
So
was the
we are
next question.
fully
Go
in
ahead.
position. Yeah, so why not? Because gold is not resoundingly over $2,000, and this is a 1 year build. It's a relatively short mine life of 8 years, and our shareholders want to get the best value for the gold that they own. And it's entirely safe. It's a good reserve in gold, and they want the best price for it. So they're watching the price of gold very closely. And, we've attempted $2,000 gold once. If we hold that level, I'm sure they'll turn this gold into cash, which it can do in 12 months time.
So you're
So
saying your
that's the
shareholders have
reason.
actually told the board not to greenlight the project yet?
Correct. Exactly right. 100%. It's not
Huh.
the right price of gold.
All right. So that if that were otherwise, you would build the project based on the pre-feasibility study, or are you planning to go ahead and
Absolutely.
complete?
Yeah, there's the only reason that the study is a pre-feas is to do with the pit angle at the larger pit. And we set that at 45 degrees. So the risk of that pit angle is actually zero. But to get a sign off on the geotech, it's about $200,000 worth of drilling. And that's the only thing left to do to convert that to a definitive feasibility study. And there's no risk at 45 degrees, so there's no reason to do it. And actually, to go through the permitting process, you need what's called wet construction level drawings. So you need everything signed off by an engineer in detail to construct to get the level of permits we have. So from an engineering perspective, we're way past a DFS in our construction plans anyway.
I
So
was
we would build it now
I was wondering
if
about that
gold
because
price is right.
in the presentation it mentions proven and probable, but normally you need to have a feasibility, proving the economic numbers there to be able to say you have P and P.
So you can have proven and probable under 43-101 on a pre-feas. You can declare proven and probable reserves in the Canadian system, which we have.
I have not seen that before. It's usually at the BF.
Yeah, I've seen it many times in other companies I've been involved in as well. Mag Silver, for example.
All right, so if you don't mind, let's go back through a little bit of history because you've done some things recently that made me scratch my head a bit. I remember at the time, it was like 10 years ago or something, we were on the project, and there was a complicated ownership. You had Allied Nevada, and then Waterton took them out, and then recently you guys took Waterton out, but they're miners or trying to be. Why would you not want to partner? Walk me through. Why was it better for shareholders for you guys to get rid of your partners and take this over 100% yourselves?
Sure. So that's an easy one. It was a super accretive transaction. Waterton was a 25% interest holder, as you mentioned, through the bankruptcy of Allied Nevada on their stuff in northern Nevada. They picked it up out of bankruptcy court, along with a basket of other assets. So that's how they acquired it. And they agreed to sell it to us for $10 million and a million shares, which was based off of our market cap. So that the value of that purchase was our market cap. If we look at the NPV, the real value, independent engineer calculated, that was a $73 million NPV. So it was an obvious, super accretive transaction to us to pay $11 million for over $70 million worth of NPV. That was a no-brainer. So it was a very, very good transaction for us, and it gives us 100% control of the project, which leads into our next transaction, which is the canceling of a royalty. So and creation of a new one. So we bought a royalty on our own property as West Vault from Newmont, and we traded them a piece of exploration ground they coveted in Long Canyon in northern Nevada, and we got a royalty back over our own property. That wasn't owned by Waterton, just by us. So we looked at the value of that royalty. We said, you know what, when we did that transaction, we got a bunch of inbounds from royalty companies, and we just recently did another transaction to cancel the royalty and create the equivalent one in a stream. So we just completed that transaction, and it brought in $6 million in cash US, and it added another $1 million at a construction decision. So we effectively sold a 1.4% stream for $7 million.
Right. So there are several things I want to tease apart there.
Sure.
Why would you do that? Why not just extinguish the royalty and add to the margins? I guess you have a high margin project already, but it looks weird. Extinguish the royalty and then go ahead and turn around and create something equivalent. Why do that?
It was just a way to effectively transfer and sell the royalty. We canceled the old one, created a new one, which was the same. It was a 1.1% NSR. We created the equivalent in a stream format, which is what the buyer wanted. So what's interesting is the NPV numbers that I quoted you on the project, they include that royalty. So there's no downgrade of value in the public's view of value of the project, and yet we brought in $6 million
Right.
in
So you
cash and a
got you got
future
money
$11
for it.
million payment. And again, if you look at that compared to issuing shares, we're trading at 0.2 times NAV or less. So, now we're trading out value at 0.74 times NAV instead of issuing shares at zero point 0.2. So again, it brings cash into the company. That's an accretive way to do it. And this is a consistent theme, right? Buying out Royal Waterton was the same. The royalty is the same. Our shareholders are very, very conscious of the value of the asset and the gold in the ground. And this is a way to do it that doesn't dilute shareholders at 0.2 times NAV, which is what we're trading at.
It just seems, I get that the royalty was already there. You have no more royalty than before, but you do have $6 or $7 million that you didn't have before. I get that. But if you're sitting there at the point of construction decision, you've got your final permits in hand, you're ready to build a mine. It just seems like, why not go ahead and raise the capex?
Okay, so but think about it. If you did that, you would issue shares for that $6 million worth of capital at 0.2 times NAV. And you've got a way to pass something on at 0.74 times NAV and get the same money. So it's definitely
I'm just saying, why not go bigger? Why not go ahead and raise the $50 million you need to build the mine? Tick off that last box.
Because again, that's at zero point 0.2 times NAV, and we think that the value of the company will have to adjust as gold becomes of more interest. And we saw this before. I mean, the stock's trading at $1, it's traded at $1.90. So why would you go ahead and issue shares at $1 to build a mine today when you could easily issue shares at $1.90 or better with the interest returned in gold? So it doesn't make sense for our current shareholders to issue that stock. They firmly control the company. Sun Valley Gold owns 46% of the stock. Ruffer owns 17%. There's just no reason for them to do that.
If they're optimistic. I mean, it just seems like I hear what you're saying. On the other hand, even at much lower gold prices, you have a very high rate of return. And you never know. What if gold goes down instead of up? If you're you got to be pretty bullish to.
And the shareholders will be wrong. But the bet on this company is on gold, and this is a reserve of gold. And if you want to own gold really inexpensively, this is a way to do it. And it's safe. We're not going to blow our brains out in exploration. Yes, you don't have a huge upside in finding drill holes here, there, and everywhere. That's not what this company is about. This company is about owning gold that you can get the appreciation and the value of gold and get return on capital efficiently. And so it's a different animal than your typical smaller gold company. And that's our niche. That's what we're looking for, long-term shareholders that are interested in safe gold.
Safe gold. All right, I'll give you that one. All right, safe gold in Nevada. It's undervalued. Why, if it's that straightforward, why the name change? Why the share rollback and the name change? I mean, that sort of thing just always makes me think, we're trying to hide something from the past.
Listen, it's hard to sell a company with a large number of shares outstanding. The company went through an exploration phase of its life. I personally lost significant amount of money in the exploration phase. We weren't that successful. And we changed our company strategy. We changed our approach to even this district in itself, that we decided that the company was undervalued for the gold that it had, and that we were not going to issue shares to continue to explore and make that risk bet. And that change of strategy resulted in a change of name to reflect the different approach. And it also made the shares more marketable because it's not trading at a ridiculously low level. However, it's currently trading at a ridiculously low level. So maybe that part of the strategy hasn't played out yet, but certainly the name change reflects a change in strategy. It's a true strategy, and it's driven by our chairman, Peter Palmetto, who's manages the Sun Valley Gold Fund.
Well, vault, I get it. And I do
Yeah.
remember the efforts to drill before, and I do remember the hopeful theories of the geologists, and I do remember some, kind of like, oh, I wouldn't say, dusters, empty holes, but just never anything to get excited about in the exploration efforts in the
Yeah,
years gone by.
we're probably the only junior company that you're ever going to interview that says that, the immediate exploration potential is fairly limited. We've spent a fair amount of money looking for it. And, we don't, and others have as well in the district. And although it's a historic mining district and there's lots of showings around, we don't see an immediate place to double the reserves here. We don't. And so we're going to be conservative and we're going to conserve our share capital so that we can return capital to shareholders. There is a route below that larger pit, Hasbrook, which has shown results of 100 feet of quarter ounce, but it's mostly down the root of this thing. It's not across it. And so there will be an adit and there will be a deepening of that Hasbrook pit and it will add ounces. And we recently acquired a property 100% called Hill of Gold that's about 40,000 ounces historic. Now that doesn't sound like a lot, but when you've got a fully permitted pad right next to it, that can add 30, $40 million worth of return to shareholders, right? So those kind of things are what we're really focused on is how do you limit risk? How do you limit shareholder dilution? And how do you return capital to shareholders? I mean, at $2,000 gold, producing 70, 80,000 ounces a year, you can return a lot of money to shareholders. And that's what this is about.
I noticed that diagram of the route on the presentation. Was wondering if the plan was just wait till there's a pit there, then you could drill it from a lot closer for a lot less money.
Exactly right. That's precisely the plan. We know it's there. We know and the pit walls can be steepened from 45 degrees. You can certainly go and do that. And you can slot on the bottom of that in the high grade material, and you will put that material on the heap. But again, you're looking at $100,000, $200,000 drill holes to get at it from the side of the mountain. We know it's there. We know that in 8 years' time or 9 years' time, we will extend the mine life and mine that material. But why would you suffer dilution at 0.2 times NAV to play around with that? It doesn't make any sense.
All right, so I get it. Let me rewind to something else before we went off on the royalties and back on Waterton and so on. And on the one hand, I get it, value accretive for you. But for that very same reason, if there's all that value there, why didn't they take you over? Why didn't they buy the other 75% and say, hey, this is a gem, this is a peach. Let's build it ourselves.
Well, the first thing is that there's a bid-ask spread there, right? I mean, they're a large fund. It's not an important position to them. They recognize we weren't going to pay for it more than a ratio off of our market cap. And the flip side was also true, is that our shareholders were not going to sell to them at 0.2 times NAV. I mean, they weren't going to sell at 0.4 times NAV. So how does Waterton say they're going to double our share price and buy us out at 0.4 times NAV? It'd still be a great purchase, still super value accretive, but it looks weird. So they're a high profile fund. They're not going to do that either. So it's a bid ask spread where it was easy for them to just trade it out and get some shares. And it was hard for us to be able to say how do we sell to you at a price that you can pay. I mean, it didn't connect that way. It connected the other way. So I don't know what to say.
Yeah, well, okay. So broader question, not just them, but if this is so great, why is it still in your hands at all? It's okay. It's small, so it's not going to be a Barrick or a Newmont, but you've got Northern Vertex, other mergers going on out there. You've got mid tiers that would look for a sweet high margin project. Why do you still have this at all, Mike?
Well, our shareholders are not interested in selling at 0.2 times NAV. They're not interested in selling at 0.4 times NAV.
So between
until the share price and none of those mid tiers are going to come in and pay 3 times share price. They're not going to do that, right? So again, the asset is misvalued in the public market. It makes M&A very difficult, and our shareholders are not in a hurry. They're not pressurized. They recognize the value of the asset. There's no push here to make that deal at any kind of multiple that normally makes sense at this share price. When
Right.
gold gets some attention and when it gets revalued, then the world opens, right? And that's management's view as well. We're not going to go pursue M&A when the ratio doesn't make any sense. At the right ratio, absolutely. I've sold companies before. I've fought off hostile takeover bids before. I know what the number is supposed to be.
All right. So between Ruffer and Sun Valley and management insiders, you have it locked up more than 51%. Can you resist a hostile?
Oh, yeah, absolutely. I mean, it's three phone calls. I mean, you've got Sun Valley at 46, Ruffer at 17, Eric Sprott's got 5, Conway in Switzerland has 4%. There's more than there's more than 70% of the stock in 4 phone calls.
Okay.
So
So all right. So you're keeping it off the market. You have that power to say.
yeah, absolutely. Well, I mean, I don't have the power to say our owners do, right? It's
Well,
not my power,
understood.
it's our
I mean,
owners'
I'm
power.
assuming they're with you. You're telling me your shareholders are with you on the strategy, so that explains why you are where you are. Okay, so what needs to happen? It's just you're just waiting for the right gold price environment, and then you pull the trigger, or well, you still need the rest of the money. So, but it's not that much.
Sure.
So,
Yeah, it isn't that much. I mean, it's $47 million worth of peak funding. We've had offers of over 50% debt on this asset. People have looked at it because of where it is, and it's a simple heap leach. I mean, it's literally knocking the top off 2 hills. It's a gravel operation, technically. I mean, there's nothing complicated here about this. So, and actually 3 hills is run of mine, so there isn't even a crushing circuit in the first pit. You just literally drill blast it and put it on a pad, pump some solution through burnt coconut shells, and it's over. I mean, that's the whole thing, right? So, we've had offers of over 50% debt. I don't think our shareholders will go that high, but we could certainly apply leverage. And listen, we've got over $7 million US in cash. We don't have to do anything. Another important feature of this company is we run the entire company. That's claim maintenance fees, permit fees, filing fees, public company fees, audit, everything for under $1 million Canadian a year. So with our current cash position, we can wait 9 years and not do an equity financing if we had to.
funny how that works when you're not pouring money down drill holes.
Right, exactly. This is about returning real gold value to shareholders. It's different.
Well, I get it. Okay, I appreciate it, Mike. Those were some head scratching questions I had. I understand it better now. Mm, yeah. Well, and the exploration upside. There's a whole swath of questions there that I don't have. Maybe one more would be: so, what happens if you are successful? We get the gold price. We all hope. It's 2,400, whatever it is, and you build the mine. You start making money. Then what? You look for another acquisition, or you're in one of those things
Again,
where like
it all depends on whether it's accretive. So the interesting thing is when you're in this position is that it's hard to find things that are accretive. So it's not for not
that's what
looking.
I was going to say. Anything else would be lower margin. Like where are you going to
Correct.
find something with 100% margin?
Correct. Exactly. And when you're at 0.2 times NAV, it definitely doesn't make any sense because now you're trading paper of somebody who's trading at zero point 0.7 times NAV for your zero point 0.2 times NAV. It doesn't make any sense, right? So you can't do it. Like even if you think it's the greatest property in the world, you can't do it because you don't have the currency and you don't have the margin, and it's probably not permitted either. So
Yeah.
it's
But you're
very difficult,
yeah, you're
right?
thinking like a miner. I'm thinking like an investor. From an investor's perspective, you look at stories like Silvercorp had the super high grade Ying mine, and then they build this GC mine at 200 grams per ton, and it just seems like you're diluting the story. Or Klondex in Nevada, right? You've got super high grade at Fire Creek and Midas, and then you buy something at 4 grams in Canada. Like why?
All of those things. So this is managed differently by different folks, right? The 46% shareholder is the chairman of the board and runs a gold fund. They run these numbers inside out and backwards and sideways, right? There's a reason they own 46% of the stock is because they know the value. This is a value play. It's pure and simple.
All right, that I get it. That brings me to my always crowning question here is the skin in the game question. I'm glad your shareholders are so long. How much of your own skin have you got in this game, Mike?
So in previous exploration iterations of this gold company, I've lost probably a couple of $1 million, maybe $2.5 million personally. So my shares were rolled back like everybody else's. I've been buying stock recently. I bought stock yesterday. So we're a Friday rather. So you can see management and is continuing to buy the stock. So from Frank Hallam, the CFO, to Sandy McVeigh, the chief operating officer, has bought about 3 million shares. So we're continuing to buy the stock, and that was 3 million shares pre-rollback, mind you, but still. I think we have our own money in the game, but it's not huge, and you will see us certainly if the shares continue at this price, you will see management continue to pick up stock. It's just not priced right. It's not the right value.
I think that might be one of the most honest answers I've ever had to that question, because most people would have said, "Well, I've put $2-3 million into this, which I'm hoping to make good on." But you said I've lost $2-3 million on this, and I suffered the rollback with the shareholders. And I don't think I've ever heard anybody make an admission like that. So if nothing else, kudos for that. I appreciate that candor. I understand the story now much better. I confess I just didn't get how the pieces worked or why you're doing what you're doing. And I see. I will have to think about it. And
Good.
so
Good.
make sure I'm on your press release list. I will. I suppose when it comes time to build the mine, you're not going to be looking for retail participation in any financing you do, but. Oh well, keep us posted.
Listen, we're looking for shareholders of all sizes and participation. I mean, we want to see better distribution of this stock to have it properly valued. I mean, that's what the company needs. It actually needs to be valued properly so that when we do build the mine, it's done at the right valuation. That has to be an objective of ours, and that's important. And we're very, very conscious about dilution that's not at the current. That's not at the right value. If it's not at the right value, we're not going to dilute. We don't have to. We actually have the cash for 9 years if we have to. So we don't have to do anything.
And you've already suffered the dilution. You're not going to do that again. I get it.
Yeah, I've lived that movie, exactly.
That's right. All right, Mike. Well, keep us posted, and very best of luck with it.
Thanks very much. Thanks for the interview. Cheers. Talk soon.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.